So right off the bat, Alphabet talked about its biggest risk, which is search. Search engine declines in the search engine business are the biggest risk to Alphabet stock investors. This is the thing I've been talking about most over the last few years as a bullish investor in Alphabet stock. I'm watching this as an owner of Alphabet stock. I'm paying close attention to see what's going on in this segment because this segment is under threat with large language models. And thankfully, another quarter of solid growth here as the company said search delivered double-digit revenue growth and new features like AI overviews and AI mode are performing well. That's great to hear, right? Because all you've been listening to and hearing about with Alphabet is how large language models are going to kill its search engine business. And while that risk remains, it keeps getting pushed further and further out. So in the quarter which ended June 30th, the company reported 14% revenue growth, which is the same revenue growth in the same quarter last year. That's solid, up to 96.4 billion. Operating income jumped to 31.3 billion and the operating profit margin remained at a very healthy 32% margin. So Alphabet stock is now trading at a forward price to earnings of 20. Now, I updated my proprietary discounted cash flow valuation model for Alphabet stock, and I increased the intrinsic value per share as a result of a few factors. Number one, I increased my expectations for growth for Alphabet over the next 5 and 10-year periods, and not by that much, but by 2 percentage points and 1 percentage point for the short term and medium term, respectfully. And the reason why I increased my expectations of growth for Alphabet for those next few years is because of the capital expenditures, the assets that they're spending money on. I expect the return on investor capital on those assets because the company has demonstrated an ability to do that. Also, the company added roughly $13 billion in debt, and that was a positive for the valuation because if you look at my weighted average cost of capital for the company, the cost of equity is at 10.4%, whereas the cost of debt is just 6%. So the more money that Alphabet borrows, the more of its capital is sourced from debt, which is at roughly half the cost of its equity. And so it lowers the company's weighted average cost of capital. And so the intrinsic value per share increased as a result of all those factors up to $231 a share. The current market price is $190. So I see undervaluation both in terms of my proprietary discounted cash flow model.
Click the link below to watch the full video.